Hi everyone, welcome again to another financial analysis video with myself, Morid Amin, and Ted Wayman. Today we are looking at Asos. So let's dive straight in. Fashion online retailer. What's interesting is if you look at their investor relations website, they describe themselves as, their mission is to be the #1 destination for fashion-loving 20-somethings. So they try to be relevant to that particular demographic, and they sell, a range of things, everything from, accessories to clothing to sportswear to cardigans, trousers, shoes, trainers, you name it. They have a plethora of fashion retail items that they sell through their online stores. So what's interesting is they recently bought the brands Topshop, Topman, Hit Group, and I think Miss Selfridge, that was it, from a group, well-known in the UK group called Arcadia Group, which went into administration. So they bought their brands to expand their portfolio. And recently they were in the news because they changed their CEO. So a new CEO has come in. And as part of your investment thesis, that's going to be important for you to look at. We're not going to cover that today. We're just going to cover the financial analysis. Now, this particular company was a recommendation to us from one of our viewers, John. So John, this is your video. And this brings us to the point, which is, as always, like, share, subscribe. If you have a company that you would like us to analyze, please leave a note in the comment section. If you subscribe, you will get the notification for when we publish that. Quick note on the share price before we dive into the financials. It floated in 2001, in October of 2001. Since then, it has been on a real roller coaster, ups and downs. So stick around because we're going to cover that later on towards the end of this video. So Ted, let's dive in on this one. An interesting company to look at given its history and what they do. What have we found that we can share for our viewers?
Absolutely. Well, good to see you, Moeed. Yeah, let's have a look at their financial statements. We are always or often accused of being a little bit backward looking, and welcome to the world of financial analysis. These are the financial statements and tell us what's happened in the past, not in the future. Actually, at the date of recording 3 days ago, they released their latest set of financial statements. So I feel that we're not too out of date for once in our history. So what we have here is the year to the end of the 31st of August 2021. The numbers have just been released, and they're unaudited at the moment. So this is kind of just a kind of a sort of a flash. So they are subject to change, although hopefully they won't change too much. So what we're going to do is we're going to whiz through all of the kind of the spiel, and again, you are welcome to look through this, the kind of the headline levels and kind of updates on the strategy and what's going on, and look at the key metrics till your heart's content. You can do that yourselves, but we are going to look at the financial statements, and here they are. We're going to start with the income statement. So just these are unaudited, as I said, and they're compared to the previous year, which are audited figures. Turnover, so the top line sales is just shy of £4 billion, and that is a 20% growth year on year, so looking pretty good. Cost of sales is at a steady at about 55% of the sales price, leaving them with a gross margin of 45%. That looks pretty standard for the kind of the sector that they're in. So generally speaking, pretty high margin. You may remember we looked at Gymshark, who are operating on something like 70%, which is really high. So 45% isn't that bad. And then really for these guys, the big costs are the overheads. So the distribution expenses, because they're online, they're not in the stores, they don't have to pay rent, but they do have to post stuff out and then take the returns in, etc., etc. Giving us the admin expenses. So the operating profit, yes, they are making a profit, but it's only 5%, and it's a 3% bottom line margin. So that's pretty tight, 3%. So, you know, this company's turning over 4 billion and it's only making 128 million pounds a year in profit. So reasonably tight there. In terms of the growth, you know, fantastic growth. You know, you mentioned the stock price, and we'll look at the stock price a little bit later on. You know, these guys, they live in the world of fashion. Fashion is very, very fickle. The kind of the stalwart of the high street Marks and Spencers is still hanging on there. And, you know, they kind of been going up and down and sideways for, you know, well, most of my career, as far as I can think of. So, you know, these guys, the fact that they're able to grow at the moment, can they stay relevant? That's got to be the big sort of question for any potential investor. Okay, but they are operating on this very tight margin. And just the other thing to notice is that their finance expense has gone up a little bit, suggesting that they've taken on a little bit of debt on the balance sheet. But that finance they can afford. So if we compare the interest payable to the operating profit, the interest cover is not a problem. So there's the income statement, all looking pretty good, if a little tight. Let's go on to the movement in equity. Nothing really going on in the movement in equity, just to say that they aren't paying any dividends, in case you were interested. So if you're looking for income, look elsewhere. So here we are at the balance sheet, and we see in the balance sheet quite a big increase in the non-current assets. These are the things we need to run the business. The biggest increase there is coming through the intangible assets, and the intangible assets will be the goodwill. As you mentioned, these guys have been buying other companies, and when you buy other companies, you pay more, generally speaking, than their net assets are worth. The difference is known as a goodwill and appears on the balance sheet as an intangible asset, i.e. something you cannot touch. So that is kind of reflecting the increase in the the growth. So a lot of that 20% top line growth won't actually be organic growth, it'll be acquisition growth. Okay, so just to kind of highlight that. So if you want to see year on year 20% growth, then they're going to have to year on year go out and buy other companies as well, and that's expensive. A couple of other things on the current assets. You'll notice quite a lot of stock. These guys really are carrying quite a lot of stock. So I put that through my little calculator, and it suggests to me that it takes them that they carry 115 days of stock. Now I think that's going to be partly going to be sort of a reflection of the kind of the fashion and the kind of the cyclical nature of fashion. You know, you're stocking up now for I guess, you know, we're in October, so I guess you're kind of stocking up for the winter collection, and then in the middle of winter you're stocking up for the spring collection, etc., etc. But these guys, you know, they are quite reactive. It's kind of like, you know, obviously Asos is you know, originally as seen on screen, so it was like you see something on screen, you think, oh gosh, I quite like that, and then you find it on Asos for, you know, 15 quid or whatever it is. So they are carrying a lot of stock, and that's 115. On the other hand, I guess that the trade and other receivables is pretty low, and again, you'd expect that because this is effectively a cash business. You pay your credit card, place your order, and then they'll ship it. None of this shipping, and we'll pay you in a while. And then the final one to notice is that they do have a lot of cash, and their cash has gone up from the previous year. So they do have, you know, a pretty strong balance sheet sitting there. Looking down at the bottom half of the balance sheet on the current liabilities. So the current liabilities is, if you compare that to the current assets, we see that, you know, the liquidity is not really an issue. So there are the current assets, they're the current liabilities. And most of those current liabilities are trade and other payables. Again, quite interesting, quite a big number there, suggesting, again, by my back of an envelope calculation, it takes them 131 days to pay their suppliers. So if you are a supplier to this business, then you can expect that you're going to get paid a little bit further down the line. And they need to do that because they're holding the stock for a long time, and therefore they need to push back on their suppliers. Interesting enough, EU Directive 7/11 suggests that it is illegal to pay anybody after 60 days, but then we're no longer in the European Union, so maybe that doesn't apply to these guys anymore. Anyway, just to say, eyes wide open. If you are a supplier, you be prepared for some pretty hard payment term negotiations. Otherwise, the only other thing to notice on the on the liability side is this number down here, which is the debt, and you can see they've taken on a lot of debt. So these guys, they're growing. Traditionally, they've kind of been growing through their lease liabilities, but they have recently taken on a lot of debt. The interest payments is still pretty low. I'd expect that interest payment to go up. So it looks to me like the timing of those borrowings towards the end of the year. So the financial impact of the interest payments haven't really come home yet. So the interest that they're paying at the moment is mainly going to be on the lease liabilities, which are these numbers and these numbers where they're leasing their assets. So borrowings, obviously looks like that they have, borrowed money in order to buy those additional companies, and that's going to be reflected in their future profitability. So down in the equity side, everything looking pretty healthy. So this is the investment by the shareholders and retained earnings. Retained earnings going up. They're not paying any dividends, so all the money's being reinvested, and they're continuing to grow. But a stock like this, we'd expect at some point to start paying out those dividends, and we would hope that that point probably isn't that far away when it moves from growth to maturity phase. So there is the balance sheet. There's the income statement. Let's go and have a look at the cash flow. So the first thing we notice is that they are generating cash, which is good. They are generating cash. You'll notice here we've got an increase in inventories. Okay, that has a negative effect on cash, because if you increase your inventory, your cash goes down, your assets go up, but you don't make the profit till you actually sell it. So increase in inventories, and that is countered effectively by an increase in trade and other payables, i.e. their suppliers. So basically they're increasing what they've got in the warehouse, and they're not paying their suppliers. Now, some of this may be due to the acquisition as well, but it's just to kind of, to highlight those two items. Still generating cash like the previous year. They're investing, and you'll notice here, big investment is to acquire other businesses. And they're also acquiring their intangibles. So a lot of that debt. So the investment is to buy the business, and that investment is coming from the issue of borrowing. So there are the borrowings, and these borrowings are basically being used to fund the acquisitions, and B, to generate an increase in cash. So they got more cash in the bank to survive any kind of bad weather coming their way, or also maybe for acquisition or speculative acquisition opportunities. So that's really the sort of the financial statements. There's nothing really, no bigger warning signs, no kind of massive excitement going on. Low margin business, growing through acquisition. It's a well-respected brand. It's doing pretty well. It's it has been bouncing around a bit. Let's go and have a look at the share price. So if I can just pull that up, here is the share price. And you'll see, a real roller coaster ride. So if you got in at 2008, you'd have made and lost your fortune more times than I care to remember. So certainly, if you've invested late to, if you bought in the kind of the nadir of 2020, when all the markets tanked, you'd be feeling pretty pleased with the rise. And of course, if you didn't get out, then you'd be sitting there thinking, oh gosh, where's it going to go? Is it going to go back down? Is it going to go back up again? Or is it just going to do this, for example? The answer is, of course, we don't know. Okay, so this is a significant correction, and that's what we're reading about in the newspapers, with kind of change in the chief executive. Maybe it's lost its way a bit. Maybe it kind of needs to consolidate. Lost its way. That's a phrase that we've heard with Marks and Spencers, for example. Again, more times than I care to remember. However, so let's look at the sort of the metrics down the bottom. Market cap 2.8 billion. So just so the balance sheet is about 1 billion, and this is a market cap of nearly 2.3 billion. So you've got about 1.3 billion of inherent goodwill. That's a 120% premium to the net asset value, which isn't crazy kind of valuation. it's you know, the P ratio is about 19 times, 20 times. That's a yield of about 4%. Not paying out dividends. 4% doesn't look that bad. You know, we got inflation coming. You know, it's getting stickier and stickier by the day. That means that their input costs, there's no room for inflation in this business. You know, if the input costs go up, they've got to pass them on the output costs. You know, will the customers, will the clients still be buying, you know, if the prices are starting to inflate on their website? I don't know. I mean, that's the kind of, you know, the fickle world of 20-year-old fashionistas, etc. It's trading on, you know, just over 1 time sales. So it's, you know, it doesn't look cheap, let's put it like that. It doesn't look overly expensive. If you look at the kind of, you know, where it is in terms of its historical kind of, you know, if you take a kind of a chartist's view and you look at where it's been bouncing around, it suggests that maybe it's just dropped below. I mean, certainly, you know, here it's been bouncing out. This is what the chartists would do, and they kind of say, oh, look, you know, it's broken through the kind of, this is a support line. Maybe it's very cheap, and it's going to carry on, and it's going to kind of trade in this kind of pattern here. Who knows? I'm not sure I can add much more to that. So, you know, there we go. They are, you know, it's an interesting company.
Yeah, very interesting. And you know, we'd love to hear the comments of people who are experts in this industry. Right, you know, what do you have to say about this? What can you add to our analysis here? That you know, things that you will know because you're so knowledgeable in this industry that we won't know. But that's the analysis there, right? So to me, I think the word that sums up there is vanilla, right? It's apart from the stock market movement, which kind of makes me nervous for you know, a company with such low margins. Is it worth it? But those are my opinions. Would love to hear from everyone else. And you know, if someone wants us to look into Marks and Spencer, then leave a note in the comment section, and we can add that to our list. But for now, you know, that's all there is from me. This was a good analysis, Ted, and I'm sure our viewers find it interesting. Like, share, subscribe as always, and see you on the next video.
Great to see you, Marie. Catch you later.